Roll with this evening, ladies and gentlemen. Welcome to FOMC Live. Now, those of you who are new, welcome. My name is Tino. You've tuned into Traders Reality, and this is the reality that we have got this evening. FOMC. So, the market's already pricing in the idea that we know the Fed is going to keep the rates unchanged. But what we're looking for is what their expectation is of the impact that tariffs are going to have on the US economy. Now, I'm looking at price action across the board. We've got a very small amount of strength on the dollar. NASDAQ said no, and it's come down a little bit. Bitcoin's also pulled back ever so slightly after a nice little run to the upside to only bring it back down. Now, these events here, unless you're already in exposure, it's not really a day to start taking trades unless you're a scalper and you're finding certain maneuvers. But to be honest with you, it's either going to be a nothing burger tonight, or Powell is going to give the market the idea of when we could get these rate cuts. Now, if Powell doesn't talk about the GDP, which he will be in line with the federal board members' projections of what they expect the GDP to end up at in this quarter, going into the next few quarters, and of course, the start of the new year, I'm looking for Trump to say something during this time. So make sure that you guys are keeping an eye out on Truth Social whilst Powell is talking. I don't know, man. Trump could say something that could really rock the markets. And you know what, guys? You're witnessing the craziest volatility that these markets have experienced in a long time. You know, when Biden was about, it was just pretty happy sailing, man. Like when this guy, when he would talk, the markets were like, shut up, man. There's no point. He's not going to say anything. He needs to say something in order for it to happen. But you know what? I miss Biden. From a trading perspective, I miss him because I ain't got to worry about his tweets or his posts. You know, it's very rough these days, man. Anyways, did any of you actually watch Bessant's little breakdown? He was getting asked some very, very interesting questions today. And oh God, he was getting attacked by the good old gang of Congress, asking him questions and what have you. But anyway, that's irrelevant right now. We're going to get ourselves ready for tonight's live. And this is how it's going to work. In the next 25 minutes, we're going to be getting the federal funds rate. So we're naturally going to see a little bit of volatility from the markets. That would mean Forex markets are going to then have to readjust and get refinanced at exactly these rates that they are being offered at. The idea is they're keeping it at 4.25, 4.5%. So it's going to be at 4.5%. Straight after that, we're going to get the minutes. Now, the minutes is going to break down what the federal board members have all been saying about where they are with inflation, interest rates, economic expectations, and of course, tariffs. Now, Jerome can't really talk about tariffs, but fundamentally, he's going to say that there could be some tariff inflationary pressures. But then all we need Donald to do is, Donald, bro, why are you saying Donald? What we need Trump to do is to turn around and say that they're not going to be doing anything with tariffs. Maybe someone from China could actually say, yeah, we're going to strike a deal. You know, something can happen during this FOMC, and I'm hoping it happens tonight so I can all share it with you. Mad love to you, Jamie, man. Mad love for you. Welcome to the Platinum Madness. Not membership, madness. So, where's everyone's heads at this evening? How many of you are in longs right now? And I'm not saying longs with risk in the sense where you're in a drawdown, as in how long have you been in longs from in terms of last night? Were you long on Bitcoin before the pump last night? And I want to know where you guys or where your head's at, because I'm going to break down Bitcoin's price action from a day trading perspective on what could potentially happen in the next few moments when we do get the FOMC results and during the press conference. Quite frankly, it's going to be very risky given that it can go up and down. But Powell could say something that the markets might appeal to. So it's not over yet, ladies and gentlemen. There's a reason why Bitcoin's holding. There's a reason why NASDAQ's holding right now. So we're going to be making sense of that very, very shortly. Yeah, he did say he's going to announce something pretty big this weekend. I know that. But he said it's not tariff related. So it's not tariff related. Not interested. So no position. $30 to 2K in a night. Happy days. I was long, switched to short right now. Yeah, like the shorts, it's a very interesting one for those of you who are favoring shorts right now, given that the market ain't really giving us anything just yet. If the expectation is that Powell's going to say something bad, he usually ends up saying something that the market doesn't like, and then the market goes up. Remember, inflation came down and the markets didn't like it. You go make sense of that bad boy. So what I'm going to do is going to break it all down for you, ladies and gentlemen, and then we're going to get straight into it. We haven't got that long until the 20 minutes, and then we'll work out where we are with the FOMC minutes. So let's get on with the flavor this evening. Did you see what happened to Google? So just to quickly put into perspective, Google actually dropped because Apple are going to start doing some funky stuff with the Safari browser. So let's go to Google for a second. It's down 7%. That is wild. Look at that, for a nice drop to the downside, all because Apple is going to be incorporating something, or AI, into its browser. So it goes into it and says that Alphabet stocks led losses in a big tech while investors geared up for Federal Reserve decision amid bet officials will signal their wait-and-see stance until there's more clarity on the impacts of President Donald Trump's trade policies. This is really frustrating because prior to Trump's tariffs, it was, we need to wait and see what the inflation data is going to be like. We need to wait and see what the economy is like. We need to wait and see what the labor market is like. Now we've got to wait and see what Trump's trade policies are like. Then when that's done and dusted and Trump comes around and says, we're not going to be doing crazy tariffs anymore, we're going to be giving you just a 10% flat rate across the board, then the Federal Reserve will turn around and say, we need to wait and see what inflation says. Inflation will go down to minus 0.1, and Jerome Powell will say, we need to wait and see what inflation says. Unemployment market will shoot up to plus 35%. They will still be waiting to see what the data says because they'll call it an anomaly in the readings. What on earth is going on? You know what? Trump does actually have a point in getting rid of Powell. But anyway, we're not going to get into that. But here's this bit right here about Google. After Apple Incorporated said it is actively looking at reshaping the Safari browser on its devices to focus on AI-powered search engines. Do you think this was a little dump pump kind of story? Maybe, by the vector candle principle. That could be something that we could take into consideration. Quickly going over across the board to understand where we are with the bonds market, to understand where investors' heads are at right now. So bonds, they have taken a bit of a tumble to the downside, massive gap down, and it is kind of making a little bit of a move up, but it's nothing really that I'm too excited about. Going into it, the 2-year yield is currently trading 0.37% benefit. And of course, 5-year and 10-year and 30-year are trading negatively, which is pretty interesting given that the 10-year bond market has actually dropped aggressively in overnight trading. And the yields themselves are actively trading negative, which means that they are actually consuming the bonds right now. So maybe they think it's a discount. Maybe Powell's going to say something that's going to warrant the idea that interest rate cuts are going to happen. So when interest rate cuts are due to come into play, that means investors may need to start locking in yield now, which could explain why the bonds have dropped down. We made the assumption that the bond market dropping means that investors are going over into high risk as opposed to low risk. But given that the yields themselves are currently trading negatively, and not so much negatively, but they're trading negatively, which suggests that investors are going into bonds because maybe, just maybe, if Powell does say we're going to cut, whether it's in June, July, or August, the market would then say we need to lock in yield right now because the future yield earnings will be lower because they're cutting the interest rates, right? So that's where we are right there with the yields themselves. Going into other assets, the yen is down 0.72%, right? So that also means that carry traders are converting yen into dollars and then principally putting those dollars maybe to work. Now, what we're looking for right now is to see if investors are going into the dollar as a safe haven. So then we go over to the stock market and we say to ourselves, okay, is that the case? NASDAQ, currently trading sideways. And logic says that you're naturally going to be expecting NASDAQ at some point to come back into these imbalances here. But you've got 1, 2, potentially 3 tests of this range. And when NASDAQ likes to hold a range, there's nothing stopping it from shooting up. Nothing will stop it from going up. And when we look left, we've got this one area up here of 20,551. In my opinion, if they can clear 20,551, That is going to be a brilliant time for the marketplace. And of course, you are improving the odds of getting back towards those all-time highs. Not too far away. Not too far away. And that's without tariffs. That's with inflation going down. That's with no scope on where we are with the interest rates. So it's like the market's like saying, nah, I'm not interested. Don't care. Right? Investors in gold. As you can see, gold is also consolidating. So they're waiting for the next move. This could be consolidation in preparation for gold to try and make a little bit of a recovery back up towards this range right here in the red vector candle on the assumption that Powell says, yep, we're cutting rates, gold goes up. That's the logic right there, given that they are consolidating. Yes, we do have this range down here, which is deemed as an imbalance. And of course, liquidity traders will look at it and say, here's the liquidity, here's even more liquidity. And the logic could be that gold is getting ready to do the good old practice of W formation, rise, retrace, continuation out structurally. Okay. Psychologically, we're going to wait and see if investors are really going to be seeking the safe haven of gold and, of course, anticipate the idea that interest rates are coming down. So they're going to naturally go over to gold because the yield in the dollar or retaining dollars is pointless. So they'll go into gold. Now, looking at other assets across the board, NVIDIA currently trading flat, not really doing anything. Microsoft gapped up relatively well on the 1 hour time frame from last night's trading as such. Not last night. That's the gap up from the earnings itself. And then, of course, current day trading has been pretty boring. But, of course, you expect that because it's FOMC. Meta is currently up trading 1.42%. And Amazon's trading nearly 2% for the day. And, of course, AMD's been doing some business. I just need to actually pull that up. Is it AMD? Yeah. AMD or AMC? What did I see? Someone advanced. Yeah, someone put in a big pile of a big position in AMD. Or was it AMC? Wait a second. No, it must have been AMD. But anyways, nothing much really to report on that sense. Going over into Forex pairs, Euro. Currently pulling back from this range and Euro going down, yen going down means dollar is going up. But again, FOMC, that could completely change. Going over into the carry. Right now, Aussie yen is currently trading sideways, giving back most of that big pump from last night on the trade talks from China. And of course, if Aussie yen can actually succeed this 92 zone, then we could be seeing 94 if investors like what they hear from Jerome Powell, given that there is a nice vector candle all the way up here that we would like to see them try and recover, but they really need to start taking out 93.50 for that logic to be the case. Dollar yen trading quite strong, 0.74% up for the day. And if this is going to keep on going up, that means dollar is going to be the king. USD CAD's going up. And dollars up, and then, of course, US Swiss is going up. So that's going to be a bit of a problem for us. We don't want the dollar to go up, okay? So that's something that we got to take into consideration. Cryptocurrency, Bitcoin. Now, going into Bitcoin right now on the daily time frame to put it into perspective, we've got 15 minutes until it actually starts. Now, in front of you, we've got Bitcoin on the daily time frame giving us a nice little sweep up. Hasn't really cleared anything up here. And we've got a nice strong candle over here, and price has done very well to stay above the 5 and 13 EMA. Those of you that are in longs or those of you that are in spot positions, if Bitcoin's daily candle today doesn't close below the 5 or the 13 EMA, right, you've got no reason to get rid of your Bitcoin. There's been too much accumulation on Bitcoin. The ETF balance is going up, and it's already, if I'm correct, at an all-time high on balance, 619,952. So at nearly 620,000 Bitcoin ETF contracts currently sat right there. So that's pretty decent for the Bitcoin ETF. Now, going into what could actually happen in the FOMC. This is one area of interest that Bitcoin primarily should really be taking. And psychologically, if Bitcoin can claim the 100K, that's really going to mark the markets to a very interesting perspective about Bitcoin. Let me show you the order flow. In front of you is the order flow that suggests that a lot of people are piling in to sell the Bitcoin. Let me get rid of this thing right here. Look at this. There is a lot of people that want to sell the Bitcoin. Here are the orders. So we got 1.14 million, 12 million right there at 97,450. Going even further, I'm looking for bigger figures right now. 15 million, 98,000. Keep on going up. We're not really seeing it. Oh, no, nothing interesting there. 5 million, 40, right, 39 million at 99,300. Go up a little bit more. You got 40 million at 99,400. If I see another one of these figures again, then we're going to, here we go, 99,900. another 40 million, 33 million at 96, 33 million at 100,300. 28 million at 100,000. Yeah. So it looks like there's an iceberg order inside of this area here. An iceberg, which in principle, what an iceberg order is imagine this massive order, okay? And the participant has a certain amount of time to get the order filled as such, all right? And that order could be split in 20 million, so 100 million. So he's got 5 positions of 20 million that he needs to get into the chart, or he needs to buy, or he needs to sell. And that would be an iceberg, okay? So the bigger picture, it's a bigger order, and it looks like that area right here could be part of an iceberg because the order itself is priced in very close increments. 30 million at 99,100, another 30 million at 99,200, 40 million at 99,500, for example. And that's what we've witnessed right here with these orders, okay? So that could be something that we could see. But at the same time, we've also got bids down here, and I'm not seeing big bid orders. And if I'm not seeing the big bids coming in, oh, here we go, 47 million right there at 95,055. So that could lead us to believe, I mean, I haven't got that many other orders that are showing that same amount. I mean, 9 million right there. But what that's saying to me is principally there's more of a demand to want to sell Bitcoin than there is to buy Bitcoin. And I think the guys that are planting orders down here are the ones that are like, just in case there is volatility, then we could see price sweep lower to then try and make the recovery back up. So that could be volatility traders thinking that Bitcoin could actually drop during FOMC and then make a quick reversal for them to sell it back up and then try and get some of this liquidity to the upside, okay? Quickly looking at the liquidations, because that's what everyone bangs on about when it comes to cryptocurrency. We're seeing quite a few segments right here. Look, 100K carries most of the liquidations up there at the top side, okay? And this in the last 12 hours. So when we look at the liquidations, it looks like there's an even distribution of people's opinion about Bitcoin, whether it's going to go up or down. Look, you've got clusters of shorts here, shorts there, and then you've got longs down here, and down here. So 92, yeah, 92.7-ish. Then we've got nothing at 94, got between 96 and 95 is right there. And you've got these two short click liquidation points at 98 and 97, and then you've got the 100K one. So quite frankly, ladies and gentlemen, we look at Bitcoin's price action, we've just got to say to ourselves, for those of you on the daily time frame, as long as Bitcoin stays above the 5 and 13 EMA on the daily time frame, which means at the close of today, if that candlestick can stay positive, then that's going to be a good sign. And assuming that we do have good news from Jerome, the idea is that the next day's candle is going to continue, or the Asian Open tonight is going to absorb whatever news announcements comes out and principally follow on with what's going on. So that would mean Bitcoin would be going up. But Bitcoin really needs to break out of this range right here. I'd be very surprised if it can't even take that tonight if Jerome Powell doesn't give us the flavor. Okay? Now, where we at? 8 more minutes. Any questions, ladies and gentlemen? Do we have any questions or anything? First things first is what we're going to do. For those of you that are new to this live stream and you haven't done so already, go to tradersreality.com, check the front page, homepage, download that PDF. There's a link right there. That's going to take you and show you how to use the hybrid system. What I'm going to do in the next few moments is take questions on the hybrid system. So once the FOMC minutes are released, okay, and we know what that is, in the next 30 minutes, what we'll do is we'll go over some questions on the hybrid system, and you guys can ask them, and I will answer them, and I'll relay certain topics that you guys might want clarity on. But if you are new, go to the homepage on the Traders Reality website, download that PDF, because that's going to be the basis for you. It's going to help you understand how to learn the hybrid system. And then, of course, join the Discord. And then there's where you can install the Traders Reality indicators on TradingView. Okay. Once you've done all of that, happy days. Okay, cool. Now, with that being said, next 8 minutes, it's all going to start coming into fun and games on the FOMC minutes itself. Just going over to the calendar, looking at any news that could be coming out. It says, look at this. Why will the Fed, here we go, got a quick look at this one, here we go. Why the Fed will likely ignore Trump's calls for interest rate cuts. This will be interesting. Let's see what they're saying over here. It says here, the Federal Reserve could keep its key rates unchanged. Okay, thank you very much. Yep. for several more months as it evaluates the impact of President Donald Trump's widespread tariffs on hiring and inflation. Okay, so we know that could be the case, that they are going to keep it the same for the next several months. Why? Because on this chart right here with the Fed watch, excuse me, we can see that their expectations from May, as it is right now, 99%. Okay, there's no chance they're going to be cutting the rates. Going to June, so that's 1 month. There is a bit of a dispersion between where they think it's going to be, but mostly think it's 4.25, 4.5% going into the June. Go to July, you've got that reading right there where it now starts to come a bit even, where then more edge towards 4%, 4.25. And then we go over to here, September, same story. It's starting to show more weight towards 3, 7, and 4. And then we've got October. Okay, so that's 1, 2, 3, 4 months, ladies and gentlemen. 4 months, right? And I'd say that in the third month over here. So let's just go to September, right? September looks like it represents that most investors and the target interest rate swap traders have an expectation that the Fed is going to get down to around 3.75, 4% on the interest rates. So 3 months. I mean, where are we going to be with the tariffs? We know it's slowing down trade, all right? Mainly for China. All right. And also a little bit for the US. But the euro's killing it right now, ladies and gentlemen. 7.9 and 70% on the yen. Man, you're nearly getting 20% holding that currency. Can you believe that? It's actually wild. Anyway, Bitcoin's starting to pull back right now. So that's pretty interesting. Just quickly going and look at any other news itself. Fed will likely hold rates steady as Trump's tariffs spark uncertainty. We know this. Yet 4.25 and 4.5 is widely expected. We understand that. Okay, here we go. Trump officials Bessent and Greer to meet Chinese counterparts on trade. Okay, we know that already, but we're not really seeing anything other than Bitcoin pulling back right now. Quickly go over to the NASDAQ, see what that's doing. That's pulling back as well. You're going to expect, let's have a look at what commodity traders are thinking right now. So oil taking a nosedive, man. That is crazy. Oil is just trading so cheaply, and Trump did say he's going to get it below $50 a barrel. Bitcoin's pulling back right now. It's interesting to say the least. If Bitcoin is dropping, that could be good. Yes, primarily that is what's good about Bitcoin dropping right now, because if it's dropping, the bids are being collected. So we go into it, we can see, look, the bids are coming in and they're eating liquidity. So, but they're not that much. There's not that many bids being picked up. And that could be a telltale. That could be a reason to suggest that maybe Bitcoin could sharply reverse, because the order book itself is showing people want to sell. Look at the concentration of offers right there. It's like so much liquidity. And it'll be embarrassing if Bitcoin doesn't actually take 100K today. But it's all down to what Jerome Powell is going to be saying. Might not take it straight away, but it could take it in this session. Okay. Trump speaking. Trump, no potential for pulling back on tariffs on China. Oh, man. Here we go. What's he saying? Here we go. Not open to pulling back 145% tariffs. Trump, what the... Trump's not looking at for so many tariff exemptions. And I don't know on tariff exemptions. We will take a look at exemptions. Oh, he's ended remarks and swearing-in ceremony. Okay, then. China should reassess who asked for a meeting. He's playing the big D right now. You don't do that with China. You don't. You certainly don't do that with China. You know, can you go over B-shape reversals? Is V-shape reversals? Yeah. Yeah, I'll talk about V-shaped reversals very, very shortly. Anything else? Start writing out your questions so that once the FOMC data comes out very, very shortly, next 4 minutes, I'll just quickly scour through everything and we'll talk about a couple of those concepts for you all. Whilst we're doing that, there's 4 minutes until the FOMC. 2,600 of you amazing people are in this live and we only have 400 likes. The math is not making sense. There's clearly no tariff on the like button. Now, I do appreciate those of you who are watching it on TV. You just get up for like 2 seconds and maybe just adjust it. Or I don't know if you've got a screen at home where you just hit your front screen on your TV and it does actually like it for you. Come on, you're all traders. Surely you've got those touch screens, you know? I'm joking. But anyways, Malaga. Nice. That is a great place in Spain. My guy. Okay, then. BTCC regulations, UK regulations. Yeah, listen, if you are going to trade this madness and you use BTCC, just it's in the description. If you go and use it, just go over to tokenized stocks and commodities, okay? and it's Tech 100, which is the NASDAQ. Someone was asking earlier on. You've got gold on there, and you've got all the stock as well, and you've got mainly as well, you've got Forex. Okay, you can trade Euro on there. But as a hedging platform, if you are using it to trade Bitcoin and Bitcoin's not doing the thing that you want it to do, out of the two, Bitcoin and NASDAQ, NASDAQ will always move much faster than Bitcoin. Okay, so you can hedge yourself just off the speed of NASDAQ's movement. You can exploit that. So that's a benefit of using this platform. And of course, you don't need VPN and KYC if you're from the States. And of course, if you are from the UK, then you can use a VPN from what I understand. But anyways, with that being said, we're getting close to it. 2 minutes time, ladies and gentlemen. China should reassess who asked for me. Yeah, we know that one, but I don't think he should be really saying that. You know, he should not be saying that at all. Right, what we're going to do right now, just going to wait to see what the initial reaction is from the market with regards to the FOMC minutes. So bottom right, you've got the dollar dominance. Top right, you've got the NASDAQ itself. And then you've got Bitcoin to the left. In the next minute, we're going to see what this FOMC meeting minutes is going to reveal, which pretty much does set the tone for what Powell is going to be talking about. Okay, so here we go. You know what? Fartcoin got mentioned on Bloomberg. Can you believe that? It got mentioned on Bloomberg that it currently has $1 billion market cap. Oh, you know, it's a great asset to trade, in my opinion. Tino, Daily Open looks nice. Scalp, what do you think? Probably take the trade, because I'm telling you that it sounds like a good trade ain't going to tell you nothing unless you take the trade. You don't take the trade, you get no feedback off it. You won't know if you're right or wrong. You're just there in limbo, like, sounds like a cool trade. Yeah, take it, bro. Just take the trade. Know how much you're going to lose, and that's it. Exit. You hit your stop loss, done. You know, you were wrong about it. Wait for the next time. But these aren't environments right now to be trading. You're waiting for news right now. Here we go. Here we go. It's out. Right. Here we go. 4.5% on the interest rate. That's cool. We know that. What are they saying? NASDAQ's coming down quite aggressively at that. 1 hour candle. Bitcoin's coming down a little bit. Dollar dominance not really doing anything. Muted. Frankly, that's a muted. Committee judge risks of higher unemployment and higher inflation have okay, so it says judges risks of higher unemployment and higher inflation have risen. Okay. China says US asked for trade meeting in Switzerland, but then Trump's saying that, you know, who's asking for the trade. This is BS, in my opinion, about that story. Here we go. Economic activity has continued to expand at a solid pace despite swings in net exports affecting the data. So economic activity is still doing well. No rate cuts. So then that does solidify the idea why they're probably not going to cut in the next few months. So that means we're going to have higher interest rates for longer. So whatever you've been witnessing happening is probably going to still continue. Okay, here we go. Unemployment rate is stabilized at a low level. Labor market conditions remain solid. Okay, so that's decent. Gold price falls as US-China tariff talks ease tension. So we understand that. But NASDAQ's not done anything. Dollar dominance is coming into play. So they're focused on the idea that unemployment rate is stabilizing, which is not really good. We need the unemployment rate to go up to grant the idea of rate cuts. Okay, so what I think is going to be happening now is if they're getting this sort of data regarding the minutes, then it means that what's going to happen is hold on. Vance says that the US thinks Russia is asking too much to end the Ukraine war. Okay, so we're not going in that favorable way for an ending of a war. We've already got another one started. Okay, here we go. We've got movement. We've got movement. So I said it was a muted reaction, but it looks like the market's going to go back to what it was doing. So that means carry trade is going to be happening in terms of the Aussie yen. So that looks like it could be coming up. Short-term interest rate futures, slight pair losses after the Fed stands pat on policy rate. We know that. So short-term interest rate futures, quickly going over and having a look at that. 10-year futures markets are going up right there. The ultras are also moving up at the same time. Looking at the 10-year yield, that's going lower. 30-year is down as well. 2-year is flat right now. It's going down. So they're actively getting involved in these markets. Quickly going over into the German markets themselves, the European zones. What we're seeing here right now, yeah, they're really picking up Yeah, they're picking up the longer term ones now. We got 25-year, 10-year, 30-year. So they're going into longer term dated securities on the Eurozone, which means that they are more than likely going to be taking on risk for longer periods of time, which naturally does inflate the value of the euro. But NASDAQ's not really doing anything. Traders continue to see Fed rate cut likely by July. So if traders are expecting that the rate cut's going to come in by July, that means these bets should be changing. Here we go. So 55% chance of a cut towards 4% and 4.25% in July. That's the current rate that we're looking at right now. So in other words, in the next 2 months, in principle, we get rate cuts, but only 25 basis points. That's dead. I think it will be about 25 basis points, but that's what Powell's going to reveal to us very shortly if that's going to be the case, if he is going to look for a big rate cut or just a normal rate cut. Let's just quickly have a look at what Bloomberg is saying right now relative to that. So here we go. Bounces. Yeah, Trump remarks. Here we go. So rebound in stocks. Equities moved after Trump said no to the potential for pulling back tariffs on China. So he gives and he just gives and he just takes away. Traders still pricing 3 Fed rate cuts this year. Okay. 3 Fed rate cuts this year. Okay. That's decent. 3 Fed rate cuts. So let's assume that it's 25 basis point a cut. Okay. That should take us down in principle. Let's just go over to it. That should take us from 4.25, 4.5. Current rate is at 4.5. They give us 1 cut at 25 basis point, brings us down to 4.25. That's 1. After that brings us down to 4. And then after that brings us to 3.75. So we could end up at 3.75 in this year, which will be very interesting. Oh, wow. Xi Jinping says, I'm looking forward to talking ties and cooperation with Putin. That's what I mean, man. Trump's too busy showing the big D to China. And China's like, yeah, we're just going to go talk to our boy Putin, man. We know you don't like it when we speak to him. Anyways, where we at? Okay, so we got 25 minutes until the FOMC meeting actually starts itself. Let's have a look and review all these questions. How many of you in the live? 900 of you have liked the live stream. So let's get with the flavor and try and hit 3,000 likes for this live. That'll be much appreciated. So let's roll with it. Questions, hybrid system. Okay, so... Mad love to you, Hal. Okay, then. Question for the hybrid. Here we go. There is a strategy that says look for the first vector candle above the 50 EMA that finishes strong. I back tested it and it doesn't really work. Am I doing it wrong? Well, depends on what time frame you're basing it off. Okay, because if you look at the first vector candle that appears above the 50 EMA, what time frame are you basing it on? 1 hour, 1 minute, 5 minute, 15 minute, 4 hour? Okay. So ideally, it works on the principle for short-term day trading. You're looking at it to be on the 5-minute time frame, okay? But there has to be a structure. Don't just look for the first green vector candle that appears and assume that that's going to be the case and it's going to continue. Now, you might think I'm being biased about it, but I'm not. You've got to have a structure in play. So here it is. You've seen that price has made a move to the downside, right? On the hourly, that's the first blue vector candle above the 50 EMA. Technically, it should have been a green vector, but you could take that logic. Wait for the retrace. It's above the moving average. Shift out to the upside. Great thing hindsight is, okay? But look at it like this. What's going on here? You've got consolidation. That's the first green vector candle above the 50 EMA. But the problem is you've got flat line on the moving averages. That's not really great. It's not coming away from anything because the averages are flat. So price is in its happy medium. You need to have a clear move down and a clear move up, okay, if you're going to do red vector candles. So here's an example right here. So let's just go into the 15-minute time frame to make more sense of that. So let's look at this. Can you see this here? So you've got a move to the downside, all right, 15-minute time frame. It's going down, it's going down, it's going down. Then what do you see? Well, then you see price try and get above the 50 EMA, and there's a green vector above there. That's too far, right? You want to see the green vector candle breaking away from the 50 EMA. So ideally, you want it to be from below to then close above it. Sort of something like this, okay? But that's not coming from below. It's above, but it's strength. But you look left, you've got vectors you can trade back into, all right? To give you a cleaner example, something like this. There you go. Look at that one. You see that there? That's breaking from below the 50 EMA. Price has been moving down, and it's broken above the 50 EMA, retraces back into it, continuation to the upside, okay? So depending on what time frame you're trading it off and what you're back testing it off, the smaller the time frame, the more vectors you'll need to see appearing after that first green vector to solidify the idea it's going to keep on moving in that direction. So if you're on the 1 minute time frame, you need to wait for a few more vectors above that 50 EMA to suggest, yeah, it's going to keep on going in your favor. 5 minute time frame, same story. 15-minute time frame, you can have one and maybe wait for two. But then as you get into higher time frames, the requirement for the first green vector above the 50 EMA is not as demanding as what it would be on the smaller time frames. But all you're looking for in terms of the structure itself is ideally W formation, okay? And then when you've got a W formation, the 50 EMA in principle would be like this, okay? So it's trading lower. And then what you're looking for is a green vector candle to appear right here and close above the 50 EMA and trade back into the logic of whatever vector candles were not recovered from inside of this range, okay? So that's one of the strategies on the hybrid system. But I will say this to you, okay? In the PDF that you get on the Traders Reality website, so when you become a platinum member, you get access to these PDFs, okay? The main strategies that we focus on in the hybrid system are the V-shaped reversals, and then we've got the red vector, green vector candle strategy, and then you've got the block trade principle. The two main strategies are the block trade principle and the Brinks box strategy. Sorry, three. V-shape, block trade principle, and the Brinks box strategy. Those are the three main strategies inside of the hybrid system that we can come to the charts with and be like, yes, most definitely, you're going to see one of those aspects playing out continuously in the charts, okay? So as a platinum member, you get access to all these PDFs anyway. So I would strongly recommend you check that out if you do become a platinum member, okay? Now, any other questions? Bitcoin pulling back, man. Never mind. Never mind. Never mind. Don't worry. Where's NASDAQ? Oh, my days. It's just broken that area right there. That's not good, man. That is not good at all. That is horrible. Oh, my days. Okay. Tina, why don't you use Heikin-Ashi candles? It would be better for Traders Reality Indicator as you can see the momentum and see what liquidity wants to grab. See, the thing is, the Heikin-Ashi candles, yeah, they are the average of price. I get all of that. But depending on the way that you trade, if you do look for V-shaped reversals, right, the Heikin-Ashi does not give you the full picture. It gives you the average, okay? So I will always either look at candlesticks or depth of market, you know? I've tried to use Heikin-Ashi for momentum. Yeah, great. It's a great thing to use, you know? But I would always stick with the candlesticks, okay? Hybrid. When you have the V-shaped reversal on Powell's gap, should it... Bro, what are you saying? Anyways, never mind. Let me scroll back up. Anything else? Come on, give me something. What about gold in this scenario? Let's just quickly have a look at gold for a second. What is gold saying right now? So gold's moving up, okay? So what they've said in the actual press conference, it's in the actual minutes, is reasons for why the Fed is going to cut this year, okay? So they said that they're going to get 3 cuts. So investors are like, okay, we're going to get 3 rate cuts. Fine, I'm happy with that. Go and pick up gold because my expectation of dollar yield is going lower, okay? So that's why gold is going to move up, right? If today they come out with, I'm going to cut the rates in July, or we are looking like we want to cut the rates because of X, Y, and Z, market participants will already be involved in taking advantage of gold going up. So they're trying to get in now and hear it from the horse's mouth. The minutes itself has pretty much solidified it. But gold will look to keep on moving up, in my opinion, because they are looking at several rate cuts. So 3 Fed rate cuts this year. They'll price that in now, which will then lead gold's price to go higher. Okay. Could you make a video hedging system with Bitcoin and other assets on BTCC? Well, look, when you use, okay, so when you use a platform like BTCC, it's not so much, I mean, it can show you a video on how to do the hedging, okay? But it's very, how do I put it? It's all about the moment it happens, okay? So it's all based on what risk do you currently have right now in BTCC platform to say that you would need to hedge it, okay? So if you're already in risk on gold, okay, and you have a position on NASDAQ that's going against you, you could technically be taking advantage of gold right now going up and put on a little bit size just to alleviate the pressure of the NASDAQ position going against you. All right, because if you're already in a profitable position on gold, hypothetically, because hedging ideally needs to be on the idea that you're already in a profit or you already have risk and you want to preserve that risk and use the profit from that position that you're opening now to then take that profit and then add it to the existing position that you already have and use that as profit to get a free trade in principle or a cost-free trade. Okay, but it's about knowing what assets move faster than the other. I mean, look, Bitcoin doesn't really move too fast, but gold and NASDAQ and other assets in Forex, they also move pretty fast. So out of everything, cryptocurrency, Bitcoin is probably one of the slowest moving assets, unless there is news directly related to Bitcoin, okay? But NASDAQ can move pretty fast. Gold can move extremely fast. Okay, so that's where the hedging comes into play. But you really have to have a position that is opened already and be in profit for you to start playing the hedging game. Tino, Bitcoin, bearish or bullish? It is accumulating. Here we go. They're bidding. They're buying up the bids. Something's going to be said. Something is going to be said because Powell has not said anything. The conference is not done. It's not even started. And you've got all these orders up here. Now, it's whether it's going to happen now or it's going to happen later. But we have seen in the past that Powell says something in the press conference, the market shoots. This could be the preparation for it. Or it's just going to slump. It's just going to slump, ladies and gentlemen. Then we'll all be going for applications at McDonald's. Nothing wrong with that, but, you know, it's just not ideal, is it? Now, Tino, what do you think about the inventory and the cost basis in trading? Are we talking about market makers and delta neutral and gamma negative and exposures and all of that stuff? Yeah, we can talk about that another time because that's just going to blow everyone's brains. But FOMC is live now. No, it's not. It's at 2:30 Eastern Standard, 15 minutes. I ain't going to be getting no FOMC late. Nah, not at all. Tino, what about the Bitcoin projection by the end of 2025? Okay. That's end of 2025. We don't need to worry about that. Not that. Here we go. God, man, that is crazy right now. NASDAQ is bleeding out. Bitcoin's doing okay, but would you long the green vector candle break of the 50 EMA in a W formation? Yeah, if you see a W formation, right, and you see a green vector candle breaking away from that, take the midpoint of the W formation and use that as a reason to believe that it's going to continue. You want to see the green vector doing that. For example, you see it right there, and then you've got a W formation going across right there. If your green vector candle is coming away from that point right there and it closes strongly above that peak, happy days. Up she goes. Expect to retrace continuation to the upside. So that's what you're looking for. Powell is playing politics and needs to be investigated. Trump is playing the politics, in my opinion. Basically on the top of a huge Wall Street rug pull, probably. What do you think of the volatile S&P 500 index? Surely it will rise due to economic uncertainty. Yeah, probably. But what you've got to look at right now is the market. Like, look at NASDAQ. NASDAQ is just bleeding out to the downside right now. But equally, NASDAQ could easily reverse depending on what Powell says. Okay? So we've just got to wait and see. I'm looking at the volatility index, and that's moving up a little bit. The Chicago Board of Trade volatility index is trading below at 25. So there's not really any concern right now from investors. It's not in a high, it's not in a high, the higher it is, when it's high, you buy zone. Okay. It's not there right now. So and that's when it's above. That's when it's above 30. So we're just below 25. So investors, look, I'll be honest with you, the reaction to the market has not been anything that we wouldn't normally see on a normal trading day, which means that they're getting ready for what's going to happen in the press conference itself. So I'm not too concerned about that. Yeah, I've heard that everyone thinks it's been a dead cat bounce in the stock market. I understand that, but you've got to understand that this market has been motivated by news announcements. Okay, it's just been pure news announcements, and the markets have all been looking for a reason to buy. Okay, we know that the value of stocks versus bonds, the stock bond ratio. Okay, that is an important chart. I just want to quickly show you that the stock bond ratio. Here we go. So stock bonds. The stock bond ratio tells you that what is the value of stocks against the bonds? Is it overvalued? Are stocks overvalued in comparison to the bonds? Are the bonds overvalued in comparison to the stocks? Okay. So you can see that it's look at that. That is just choppy as hell. Okay. And when you've got inconsistencies in the actual, the changes in value of stocks over bonds, if you look historically, when you get that, I mean, look at September 24, we had that situation where there was stocks were overvalued and bonds were undervalued. And then there was a reset, stocks dropped, which you can see right there. And then the bonds came back up and then they come back down. And then the market continued to rally to make its all-time high again. Okay. And we've sort of seen the same thing again, right? Where stocks were overvalued, quickly get rid of that value, get it all changed, bonds drop, bonds rise, and now we're starting to try and find traction to what could be a move to the upside. It could be the move that we need, you know, because NASDAQ hasn't really broken anything significant. I mean, we've got green vectors down here that they could go back into, but in hindsight, you don't know what it's going to do before it does it, kind of thing. And that's the problem with trading. You're always trading the realm of uncertainty. At any moment, anything can be said, anything can be done. Right now, in my opinion, I think the market's reacting to the fact that Trump says we're not going to be walking away from tariffs, okay? So he's already told the market we're going to stay with the tariffs. The market's now pricing that in. Jerome Powell has to turn around and say, we're not going to increase the interest rates. We're going to cut it. We're going to give you what you want. And then the market could simply reverse and everybody loves Jerome Powell. You know, that's the story. Trump isn't pulling any rugs? Probably not. Any other questions? Tino, do I think Trump's pressure on the Federal Reserve Powell is increasing? It probably is increasing, guys. It is because, you know, it's Trump. The thing is, when Trump made out as if he could have done something about it, he hasn't. So realistically, Powell can do whatever he likes in regards to this. So dollar yen has dropped after the Fed warns of rising economic risks. Well, we know that is going to be the case, but it's not dropped that much. What the hell, man? These headlines are absolutely jokes. Doesn't matter if dollar yen drops. That's not the problem here. That is not the problem. I'm paying close attention to the bonds market. Bonds is not even moving up. Again, the minutes doesn't give you anything. They're just waiting for Powell. I genuinely think they're waiting for Powell. They're waiting for Powell. I haven't got that up, actually. What happened to all that M2 talk? Look, the M2 talk story is this, right? Let me just show you where everyone's going on about with this M2. The thing you want to be focusing on is this. The Fed overnight reverse repurchase agreements chart. Quite simply, right? Just to help you understand it, okay, without going into too much detail about what it provides. This is what you're looking for. When the RRP goes up, Bitcoin goes down. When the RRP is down, Bitcoin goes up. Okay? So when we look at it, we can see that it has been going down. What we don't want to see is it starting to move back up. Okay? If we start getting more and more and more liquidity coming in, then that kind of puts a little bit of pressure on Bitcoin. Okay? Now, let's just go to the M2 supply. Money supply. M2. Starting soon. Here we go. M1 and M2. All right? So M1 refers to cash in circulation plus demand deposits and plus other liquid deposits. M2 refers to M1 plus small denomination time deposits and retail money market funds. So you can see that it's starting to try and come up, but it's not actually cleared any peaks that we would ideally want to see it clearing. Okay. But you can see, look, US M2 money supply, it's coming away from a retrace. If you look at the top right there, as you can see, and it's starting to climb back up. All right. But the problem we've got is the yields. The yields are still high. All right. And if the idea of the M2 supply going up, that means money is becoming accessible. Well, doesn't look like it is. So that must mean that money that is being accessible is being redistributed elsewhere and not into where we would want it to be. Because right now, you can see where the money's going. It's there. 7.9% on your euro, 17 on the yen. No wonder no one's picking up US debt. Okay. Now, where we at? Ladies and gentlemen, we've got 8 more minutes of the madness before the madness actually unfolds. Okay. Just going to get my charts up. Get yourselves a cup of coffee. Do what you need to do because it's about to get very interesting. Anything else? Like the stream, ladies and gentlemen. 3,000 of you in the live stream. Okay. Tino, why is MicroStrategy still buying Bitcoin? For what reason? Because they've got a reputation to maintain and they've changed their whole business model to say that they are picking up Bitcoin. That's all they're doing. Okay. They're just going to keep on buying Bitcoin. So as long as they keep on buying Bitcoin, they will stay in business. They have unrealized profits of around 40 billion and they're generating around 6.57% yield. Brilliant. That is great. And I think MicroStrategy is making it so that corporate America can really see the benefit of buying Bitcoin. We know that NVDA is considering adding Bitcoin to its balance sheets. Florida has decided to come back and be like, no, we're not going to get involved in picking up any Bitcoin as such. But like I said, we need... I said this, we need a catastrophic event in cryptocurrency, in the financial markets to make people go to cryptocurrency. Remember, Bitcoin's got the titles, it's got the hedge against inflation, it's got it's store of value. We need that event because if the stock market crashes and Bitcoin crashes, we'll go buy to those titles. It's just another asset in the marketplace. Yeah. Higher inflation. Yeah, well, listen, we know that the Fed knows that the risks of higher unemployment and higher inflation have risen, but we want a high unemployment market, but higher inflation, that could mean 2.7% because it's now 2.4. But tariffs are going to be the one, and Trump's not moving from tariffs. Tino, what is yield inversion? Please explain. Yield inversion, quite frankly, is this, okay? Yield inversion is when the 2-year yield is higher than the 10-year yield, okay? Right now, you've got the 2-year trading lower than the 10-year, okay? Which makes sense, because if you hold an asset for a shorter period of time, you earn less. That's good news. But the gap between the yield spread is a problem. 4.2% on the 10-year and then 3.7% on the 2-year. That is a problem because the spread's too wide. That could suggest that there could be a low liquidity. And low liquidity means that the Fed needs to do something and inject a little bit of cash to avoid that problem. Because if there's low liquidity, then it means non-bankers like market makers, dealers, and what have you, hedge fund managers and institutional traders, they're not going to be planting money into the marketplace. And then the banks are there like, oh my God, what are we going to do? Like, there's no one for us to transact with. Like, can't just do it amongst ourselves. We've got to make money here. So when you've got the yield spreads, that's the problem. But yield inversion is when you earn more money holding a shorter dated security. That doesn't make sense. How can you earn more money on a 2-year than you can on a 10-year? And when you've got that, it means that investors' expectations of the future are not great. So they're going into shorter term interest rate securities, okay, like the 2-year bond, and putting their money there because they want to get their money in and take it out as soon as they can and just pick up a couple of points yield on the 2-year. We want it to go to the 10-year. But right now you've got 10-year at 4.26%, and then you've got the 2-year at 3.7%. It's nearly close to a whole percentage point, man. That's just crazy. That shows you the spread, and that's not good. You don't really want to spread. You need all the yields to be at least in a nice defined spread region. It needs to be tight, because the tighter they are, the more liquidity is flowing. The wider they are, especially with the 2-year widening against the 10-year, could suggest that liquidity is starting to taper off across the board, and that's no good. Nice little reversal from the BTC. Come on, Bitcoin. So that's it. How does one become successful in prop firm accounts? Give us some tips, bro. I'm struggling. Lost 4K today. Blew it. You shouldn't have lost 4K today, bro, because you shouldn't have been trading these events. That's the problem. You've got to just say to yourself, I'm not going to trade these events. All right. Even with the Platinum Trade members as well. Platinum membership. Said to them today, I'm not giving you no setups. Why? Because yesterday we had a great day. And if I encourage them to trade today, they're only going to give back what they made yesterday. No point. Wait until you get the information. It's not about how you approach prop firm accounts. They've got a criteria. Stick to it. Don't trade certain time frames and don't risk too much. Try and put sample size of trades. Work on your execution, because there's 101 prop firms out there that will give you different rules and regulations on what you need to do. I tried the prop firm game, made some money from it, got pissed off because I was getting told that I can't make a certain amount of money over a certain period of time. I was like, what the hell is that? So forget that. So I only now trade live funded accounts, as in my own cash, because I've got the freedom. And that's the thing about prop firms. You can rip it with prop firms. And there are traders out there that are killing it with prop firms, and they will be the reason why prop firms won't exist. Okay, because they're just going in cleaning up house. All right, but you've got to make sure that you execute a system that you can say, look, download this. How to get started with the hybrid system. I tell you how to trade in that PDF. That's free. Just do it. Go and do that PDF. Read that PDF. All right. And then you want to apply that all, become a platinum member where you learn a bit more about the hybrid system and how you can apply it in real time, and join the gang in the Discord where we put the setups and what have you. Okay. That's where you learn more about the hybrid system. But just download that PDF. It's on the Traders Reality website. Just go through it and you'll know exactly what I'm talking about with how to trade the hybrid system. Okay? Ladies and gentlemen, it's POW time. All right? Let's get with the program. Here we go. We've been chatting too long. We need to listen to Jerome now. Got the headphones on. All right. Here we go. Come on, boy. I've missed the kid, man. I've missed him. I have. I'm not going to lie. I have missed Powell. Whilst we're waiting, where are we at with the likes? 1,303. We want 3,000 likes, ladies and gentlemen. We do want 3,000 likes. Let's see. Yes, I am leaving that. Here we go. Right. No, don't do that. Okay, then. Get ready for it, ladies and gentlemen. Boy, oh boy, I'm looking forward to this. Right, 15-minute time frame. For anyone that is new passing through, this is the 15-minute time frame chart for Bitcoin. We're going to have... Here we go. Forget that. Never mind. Let's play this game and get this party started. Come on. I can't wait to hear this guy talk. Come on. 29,000 people are watching this bad boy right now. Here's the boy. Purple tie. Look at him fixing his belt. Come on, pal. Here we go.
Good afternoon.
What's good?
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored.
He's losing his game,
Our
man.
obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans.
Blame tariffs.
We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
No, you don't.
Steve.
Steve
Leisman,
Bloomberg.
CNBC.
Oh,
Thank you, Mr.
CNBC,
Chairman, for
sorry.
taking my question.
A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timrose of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
John.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say,
Go on, boy.
I mean,
Say it.
so
Say it.
let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today, and we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
This will be interesting.
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're really not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet.
Oh my God, what a guy.
We all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that, but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
MacroMicro.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not on your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
That was so funny. Sorry.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News.
Oh, my days.
You've
She's
said
back.
wait and see, and the economy is doing fine today, but the impacts of tariffs are already showing up at the ports, businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the, you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economy, weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
I just shut it down, man. What a guy.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that, you know, in March, there was guidance that 2 cuts might happen. You know, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
You know, we don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And you know, we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. You know, it could include us holding where we are. We just are going to need to see, you know, how things play out before we make those decisions.
Great, and just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. You know, I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, you know, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. You know, I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Honestly, man.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path.
God's going to say it's a
to us to give them
shambles.
advice.
I'm telling you now.
Or
he's
do you
gonna
think that
say
they should take
something.
macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any
Didn't hear what she
more
was
than we
asking.
need their advice on monetary policy.
He's laughing. He's took the piss out of Congress. Go on, pal.
Thanks, Mr. Chairman. Andrew Ackerman
man.
with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Oh, my days. I'm going to remove that from my vocabulary. Wait and see, man. What a wind-up merchant.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic era shortages and higher prices. if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have a different, we're in a new phase where it seems to be we're entering a new phase where the administration is entering into beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Oh, my days. Wait and see. Wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter.
How's he got
Do you
a
think
spot
that
there?
this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to
He can't take it.
your future decision?
Okay, so I mean, I think we think that
How's asking the
there
question
was a
in
big
his own
spike
mind?
in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up.
Why is he
It
going
may
on
actually
like
go
he
into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to. I don't think it's going to affect our decisions. I will just say though that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Don't follow up.
Courtney.
Imagine if you.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
How's he finished that sentence?
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data. And we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Last question, ladies and
Chair
gentlemen.
Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
Damn. Ladies and gentlemen, Jerome Powell. Listen, man. It was Powell's reaction to that Japanese guy's question. Powell did not understand what he was saying, and he just come out with some random stuff. All right? That just awkwardness, what decision? Powell's been on fire today. He actually has. Right, let's just have a look at what's going on in the marketplace. Bitcoin comes down, it comes up because it's just absolutely BS. All right. The euro's taking a bit of a tumble to the downside. Dollar dominant strength is coming in. There you go. So there's a nice little flavoursome move up on the dollar itself. Gold is coming down. So they could actually, given that they're holding it in the range right now, seems like they're just doing really well. I mean, look, Disney's up 10%, so that's doing all right. I mean, it's just, I can't take it seriously. You know, I'm going to go back and watch that myself. I've got to watch it again. All right, listen, ladies and gentlemen, it's been a pleasure. Mad love and respect. But, you know, if you need anything on the hybrid system, you want to make sense of this system we use, the Traders Reality Indicator, go to the Traders Reality website and just download that PDF, guys. All right. And I'll be tuning into you all later on. All right. Not later on, but tomorrow. Mad days, man. See you later, guys.